So another option to business owners are defined benefit plans. So previously we've been talking about defined contribution plans, right? So there's kind of some guidelines on how you contribute, but then the investment risk, the growth risk is put on the owner of the plan, right? The individual employee or business owner, in this case, you. Uh, but there's also defined benefit plans, like a cash balance plan or something like that. So these can be a nice add-on strategy, and they're based on a promised future benefit, like a pension amount, rather than an annual contribution. Once again, defined benefit versus defined contribution. So for 2025, you can fund an annual benefit up to $265,000. That's a big number. And there's potential contributions of over $100,000 annually for older owners. And there's kind of actuarial stuff that's going into this. So actuarial calculations are going to determine the required contributions. Advantages: highest possible contribution of any plan type, right? And that's going to lead to tax savings in the year of contribution. They can be especially beneficial for high income owners over the age of 45 plus. And in fact, probably the older you are, the more beneficial these are. And you can combine with other plans for maximum savings. So you could layer a defined benefit plan, like a cash balance plan, on top of, say, a 401k or something like that. Disadvantages: mandatory annual contributions. So you might be required to contribute a massive amount of money in a year where the business profits are slim or something like that. So these are really only for when you have high confidence in your cash flow generation for a series of years. Lots of professional assistance is required because you need actuarial services, you need plan sponsors, all this stuff. So there's an administrative burden that goes along with this. And then also, like I said, there's less flexibility in low income years. So if you have to make a big contribution and the business profits aren't there, it doesn't matter. You got to put that money in. So there's just less flexibility with these types of plans.